Welcome to today's webinar, Minimizing Risk and Maximizing Financing Opportunities in Cannabis. This webinar is being recorded. All registrants and attendees will receive an email later this week with a link to view the recorded webinar and presentation materials on demand. Today, we're bringing together the cannabis knowledge and expertise of our fellow BRP partner firm, Alpharoot, as well as our industry partners at Davis Gilbert Law, New Lake Capital Partners, and the National Cannabis Risk Prevention Services. Our hope is that once this webinar concludes, you will have a better understanding of some salient cannabis risk and financing topics for 2022 and beyond. Now, without further ado, some introductions. I will be your host and secondary moderator today. My name is Hunter Baldwin, and I'm a risk advisor at Alpharoot, a national risk management firm headquartered in New York City with colleagues across the country. At Alpharoot, we believe an acute focus and deep understanding of the cannabis market is a prerequisite to architecting sound risk management insurance programs for our clients. We stray away from serving other verticals that we believe in order to steward our clients properly through a challenging marketplace. A laser-like focus on the cannabis industry is needed at the bare minimum. Through our industry expertise and our new InsurTech platform at app.alpharoot.com, we architect sound risk management programs by analyzing each detail of our clients' programs to account for often overlooked exposures. This holistic approach nets our clients best-in-class risk management architecture for the commercial risk programs and allows us to be more than a broker, but a source of trusted advice throughout the lifetime of our partnership. And now on to our panelists. Our first panelist is Alex Herding, Chief Risk Management Officer at the National Cannabis Risk Prevention Services. With enthusiasm for the cannabis plant that is palpable, Alex is dedicated to improving the industry through his wealth of knowledge on risk management, worker safety, product safety, and business development. As an advocate for legalization for over 20 years, Alex has dedicated his life's work to correcting the harm the war on drugs has done to individuals and communities across the United States. During Colorado's Green Rush in 2009, he started as a medical caregiver growing plants for patients in need, and at the turn of the state's adult use laws, received one of the first retail cultivation licenses. Over the course of the last 11 years, Alex has used his experience through lessons learned as fuel to equip business owners, entrepreneurs, and dreamers to shape the future of cannabis with the tools necessary for success. The innovation of the CRP squared tool is a direct result of Alex's deep-rooted understanding of the trials and tribulations faced by those who, similar to him, have been climbing the same path to establish a stable, fully functioning cannabis business in an industry that isn't structured safely, fairly, or sustainably. Our second panelist and my colleague at Alpharoot is Isaac Bach, our Managing Director and Head of Strategy. Isaac first joined Founderfield in 2017 before taking over their newly created Alpharoot department, which is dedicated to changing outdated perceptions on holistic medication. Isaac's focus on relationships is key as he realizes people are who they surround themselves with, thus continuously pushing to be among the best, both in insurance and cannabis. Next is our main moderator today and the brainchild of this discussion, Joseph Chiaffi. Joe is Davis Gilbert Law's Chair of Insolvency and Finance Practice Group Leader, where he helps capital providers and borrowers navigate lending laws and regulations, commercial real estate financing and leasing, and other areas that make cannabis especially complex, such as applicable state-based creditor rights and debt enforcement proceedings. Davis Gilbert is a 120-year-old law firm in New York City that has a history of entering emerging markets early and grow. Beyond providing financing guidance, D&G is a leading firm in advertising, marketing, trademark, intellectual property issues, and uses that knowledge and industry know-how to help cannabis companies establish themselves in the U.S. market. And last but certainly not least is Anthony Caniglio, President, CEO, Director, and Board Member of New Lake Capital Partners. He co-founded New Lake in 2019 and served as its Chief Executive Officer until the merger with Green Acreage in March 2021. Prior to co-founding New Lake, Anthony was the CEO of Primary Capital Mortgage, or PCM, a residential mortgage company. Prior to PCM, he was a managing director at JP Morgan, leading various businesses, including a startup platform, leadership positions, and helping grow business line profitability exponentially. During his 14 years with JP Morgan, Anthony was named by Dealmaker magazine as top 40 under 40 on Wall Street and led complex transactions such as the financial restructuring for TMAC and Chrysler Financial, as well as AmeriCredit's $3.5 billion sale to General Motors. Anthony has led numerous initial public offerings for REITs and corporations, including MasterCard's $5.3 billion initial public offering, With more than 30 years of experience, Anthony is a proven executive possessing a unique mix of skills that have allowed him to be highly successful in the context of a Fortune 100 company, as well as a startup. Anthony is experienced NYSE board member, serving on the audit committee and special committee of Atlas Resource Partners as independent director. In addition, Anthony serves on St. Mary's Hospital for Children, the largest post-acute care pediatric facility in the tri-state area. Anthony serves as the chair of the IT and cybersecurity committee, member of the audit committee for St. Mary's Hospital for Children. He was a recipient of United Hospital Fund's 2018 Distinguished Trustee Award. Anthony also serves as an advisory board member, speaker, volunteer, and coach. Anthony received a BS in accounting and finance from the State University of New York College at Oneonta.
Oneonta. And I think my mom gave you this introduction. This is unbelievable.
Yeah, this is definitely beefed up. Oneonta. Anthony was also a CPA during his tenure at Price Waterhouse.
Wow.
With the intros out of the way, our main moderator, Joe, will open up our discussion today on risk, financing, and everything in between. Now you can take it away.
All right. Well, thank you very much, Hunter. Appreciate it. Anthony, okay, we're going to get started now.
All right, let's do it.
All right. Okay, so before we talk about minimizing the risk, I think we just need to remind everyone just how great the opportunity is. Just a little background. 31 states have decriminalized cannabis, 19 states have legalized medical and adult use, 37 have medical cannabis laws. And sales in 2021 were $25 billion. They're expected to jump another 7% to $27 billion in 2022 and really grow exponentially from there. So you would think with those kind of numbers, we would be attracting a lot of capital to the space, but of course, federal illegality is keeping some finance sources, especially banks, on the sidelines. And that's because the Safe Banking Act, has not yet made it through the Senate, and banks remain subject to onerous guidelines and monitoring obligations under the Bank Secrecy Act. So, that said, there are more banks in the space than one might actually think. It's been reported there are 553 banks and 202 credit unions providing services to cannabis businesses through 2021. So a banking relationship is possible, but few really agree to lend. They'll start with the relationship before they will lend. And when they do agree to provide credit, it's more likely to a larger multi-state operator. Startups have some options, but they may have better luck with the private credit source, and interest rates are relatively high. They can be in the 20% range or higher. We have seen some public deals where the interest rate is closer to 13 or 14% as well. Ultimately, the cost and the terms are going to depend on the perception of the risk, and the value of the collateral according to the lending source or the capital provider. And often lenders really want to lend against hard assets. They want to lend against real estate. Interesting note for 2022 is that overall funding is down in the space. Not so surprising given the economy, but it's overall down, whether it's debt or equity. But equity has declined more than debt has, relatively speaking. So that debt is a little bit higher, more debt funding in 2022 this year than we've seen than an equity capital providing so far this year. Makes sense given the environment and the maturing of the industry as well. But the debt market is still tight, and for a cannabis company, especially a new one, it may need to seek an equity investment. And in the very early stages, this can mean angel investors, can mean family and friends, but that's becoming more and more difficult because everyone, it seems today, thinks they are a professional investor. So it's a little harder to find. And so what will happen often is the investors are looking for some type of preferred return. So you'll see either options for seed preferred equity or a convertible note, a note that would convert into preferred equity, or something called a SAFE, which is a simple agreement for future equity. And when we're talking about preferred equity, there are downsides for operators, including likely having to give up a board seat, so some control. In terms of granting consent rights to major decisions, as well as what the investor would like. It requires a valuation of the company very early on, maybe during a time of uncertainty and rapid growth. A convertible note for preferred equity, might be better for the operator because it kicks out the need for valuation. And for the investor, it might be good because the investor can maybe get the shares converted at a discount or be subject to a valuation cap, which would protect them in a case of dilution. But overall, what we're seeing get a lot of traction these days is a safe vehicle. Again, that simple agreement for future equity. It's because it's got the benefits of a preferred note, but it doesn't consist of debt. It doesn't show as debt on the balance sheet. So that's getting a little bit closer look. But in any case, when it comes to any equity instrument at all, the operator should really expect there's going to be significant negotiations in terms of dilution, consent rights, and any preferred returns, right? So it's an option, though. Equity is an option, debt is an option, but given this environment that we're in, real estate investment trusts or REITs may be the answer, at least for maturing companies. And Anthony, as CEO of one of the most successful REITs, I'll turn to you for the first question: is how do you provide the needed capital to the industry? What is it that New Lake offers?
Well, thank you for having me. At New Lake, we're a real estate investment trust or REIT focused on acquiring properties from and for cannabis operators across the U.S. We focus on providing non-dilutive capital, that's non-equity capital, non-dilutive capital to operators for their dispensaries or their cultivation facilities. Some of them could be large-scale cultivation facilities, upwards of $60 to $70 million, all the way down to $800,000 dispensaries. Two quick examples is we've purchased fully operational cultivation facilities from some of our tenants, but we've also purchased land and done a fully what we call a build-to-suit transaction, providing capital for them to build a 100,000 square foot cultivation facility from the ground up.
Thanks for the explanation, Anthony, and it makes a lot of sense. It's such a timely offering right now in this environment. So when do you think, in terms of the companies, when are they ready for that type of product? What do you offer?
Yeah, I should first say that sale-leaseback transaction is a common form of real estate capital outside of the cannabis sector. Companies such as Starbucks, Walgreens, Home Depot, FedEx, just to name a few blue chip companies, use sale-leaseback as a regular way to fund their real estate capital needs. What they realize is that having a hard asset like real estate on the balance sheet is often not a very efficient use of capital for those companies. And so the companies in this sector are actually utilizing it, I think, in a very capital efficient manner. So when is a company ready to execute a sale-leaseback transaction? Well, number one, you have to own the property, or you have to have your eye on a property that is for sale. Number two, understand that these contracts that we enter into are 15 to 20 year leases. So they're long-term leases, and we underwrite those long-term leases to make sure that we're going to get paid rent over that 15 to 20 year period. So companies that are ready for sale-leaseback will be companies that have a track record of providing some cash flow, some profitability, to be able to get someone like us comfortable that they'll be able to continue to generate enough profit and cash flow from that location in order to pay the rent for 15 to 20 years. So what we typically see is, yes, the large MSOs will execute sale-leasebacks, but we also see some single state operators. In fact, we have a couple of folks in our portfolio that are single state operators that have built a really strong business, that have a track record of generating sufficient cash flows and profitability. Or if you're not quite cash flow positive yet and you don't quite have profit, if you have the right trajectory and you have line of sight to those key important metrics in the underwriting for our business.
Anthony, I think that says, people should be really encouraged listening to you, right? You can kind of fit the needs of the operator. No one necessarily is out of the running to do business with you. You'll look at their track record. So with all the options that folks have, though, do you think, as we said about, there's more debt funding this year, but should anyone be holding out and waiting for safe banking to pass and think that there's going to be more funding options and maybe at a lower cost?
Typically, I'd say no, but given we're so close to the lame duck session, waiting another 6 or 7 weeks to see how it plays out, Sure, unless of course if a company needs the capital more urgently. But here's what I'd say about SAFE and what I'd say about waiting. When we started this business in early 2019, I had a number of folks say, Anthony, what are you wasting your time for? Safe banking will pass by April. This was in 2019. Safe banking will pass by April and you're out of business. And here we are. And so I really would caution this industry to say, things take longer than you think, they're harder than you think, and they cost more money than you think typically. And so no, outside of waiting for this lame duck, sure, but outside of that, I would not be staking the future of my organization on the hope and prayer that we're going to get the federal government to step in and do the right thing. I'm going to take the over all day long and twice on Sunday, quite frankly. So I wouldn't wait. I'd start those conversations as soon as you can, because windows open and close, and there's very limited capital out there, and you're in competition with others for that capital. So I'd get at it.
Yeah, I think it's great advice, and and good to hear. We have to deal with the hand that we have right now. We don't know what it's going to be, and plus cash needs are what they are today, right? When it comes to providing credit, when it comes to doing a transaction, can you talk a little bit about your diligence, what an operator can expect in terms of the process and the timing of it?
Yes, and an operator could expect, this is generally speaking what everybody does, so whether it's us or somebody else, expect a 6 to 8 week process to complete a transaction. And for sure, we've closed deals in as quick as 3 weeks. But the timing is really dictated by third-party service providers. And what we often find is that the long pole in the tent is title, or it's a survey. It's the stuff that you can't necessarily control. We can review documents and turn documents quickly, but it's those outside service providers that typically take a little longer. Many times the clients aren't actually ready for the diligence. They don't have all the diligence documents on the subject property ready. So it typically takes 6 to 8 weeks, but could be faster. And I would say be ready for anything related to that property, whether it's making sure you have deeds, you have surveys, environmental reviews, and knowing that we'll need environmental reviews for a property that are within 6 months. Sometimes you have somebody say, I bought the property 2 years ago and I pulled environmental then. No, we're going to need something that's a little bit more current, a little bit more updated. And don't underestimate the title issue. It's like everything else in cannabis. It takes longer than you think, it's harder than you think, and it costs more than you think.
Yeah, and then once you close, then how do you actually continue with all the complexities and the local laws and all? It's current. It always evolves, right? So how do you ensure the operators are meeting their local requirements, including use permits? Like, do you rely on the tenants going forward for the most part? Do you have, how tight are the inspection rights, audit rights, and what do you do to just make sure that folks are keeping up with the ever-changing legal landscape around them?
Yeah, these are good questions. And this is an important one. So as part of our initial underwriting, we're taking a look at the tenant's compliance record. We're taking a look at their infrastructure to maintain compliance, and we're making an assertion around their ability to manage a high growth business in a highly regulated industry. So we're looking at that compliance infrastructure at the outset. And do we think they have the chops to be able to do it on an ongoing basis? On an ongoing basis, there is the primary responsibility on the tenant to provide disclosure for any compliance issues. But of course, since a lot of this industry is publicly available information on state websites, we're always monitoring to make sure that we're identifying any issues at our properties or with one of our tenants. We also have in all of our documents, all of our leases, we also have parent guarantees. So we're tracking the tenant at the specific property level, but we're also tracking the operator at a more macro level.
Got it. Okay. So yeah, and so that's very important. I like that you mentioned like parent guarantees and credit support and enhancements are important here. So I wanted to touch on that in terms of enforcement, because even if we expect and plan for operators to be successful, there's something very different about the cannabis space that we all know. That's the possibility that bankruptcy protection is not going to be available to the operator, for an insolvent company, particularly one that is plant touching. So enforcement can really be impacted by state laws and insolvency proceedings, and a lot of folks just aren't that familiar with them, and rightfully so, since there's 50 of them. So we talk about things like receiverships and assignment for the benefit of creditors with our clients in terms of enforcing rights. So given the absence of the bankruptcy option for operators, what rights and remedies do you seek? So guarantee is an important credit enhancement. Is there anything else you would cite as being very significant that operators should be aware of?
Another good question, Joe, and I hope our tenants aren't thinking of bankruptcy. Otherwise, we really haven't been doing our job, and they shouldn't be a tenant. But these are long contracts, as I said, so certainly that economic environment evolves, and notably these net lease REITs that are out there outside of the cannabis sector always have tenant issues because, again, it's 15 to 20-year leases, and the world does change. The answer to your question really depends, and you touched on it, depends on the domicile of the tenant and of the parent. Some of these are Canadian-based MSOs, and so we'll find that they seek protection in the courts up in Canada and seek appointment of a receiver up in Canada. It could be for the US-based operators that it's going to be handled in the state court system, and the states vary in terms of how they approach creditor rights and property rights and landlord rights and tenant rights. And so our analysis really looks at what's on the books at the state level, how will the state courts handle such an event, and what have we seen in previous situations, because there have been a number of cases that have gone to the state level. There have been a number that have gone through the Canadian receivership. And so by and large, I'd say that these deals tend to get worked out in a fairly orderly manner, at least the ones that we've seen thus far. And we think the absence in federal bankruptcy, while an obstacle and while it being something different, means you'll have to work a little bit harder, again, like everything in cannabis. But generally speaking, I do expect the transactions to be worked out where you're able to manage through a disruption, and you're able to have an orderly unwind of a situation or an orderly recapitalization, as I point out. Ianthus is an example for that.
Such an excellent point, Anthony, is just the idea that the absence of federal bankruptcy court means there's the absence of a ready forum for everyone to work out their differences, if there are any. And so it's going to motivate folks to work things out and to resolve them, which, by the way, in bankruptcy court is what a bankruptcy judge is prone to do anyway, which is go outside and try to figure it out.
Right. And I just thought of a recent example of where this played out. Thor Equities, which is a large landlord, was renting space to MedMen. MedMen stopped paying. Thor took them to federal court in New York, and then MedMen went in and petitioned the court for dismissal on the premise that MedMen was in an illegal business and therefore it was an illegal contract under federal law and it should be kicked out. And so what did Thor do? It was really the wrong venue. The judge didn't really dismiss the case, but said, listen, this is not the right venue for it. Thor rescinded the case and is moving it into the state court system. So there's a real life example of where it went into the federal courts, but it's really properly placed in the state courts.
Anthony, now you're scaring me because you sound like you also are a lawyer as well.
No, I am not, but I like to play one on TV.
Good for you. You're not. So let's just move on from performance risks. So these touchy situations. Let's talk about risks that we actually can insure against, to prevent the depletion of assets in the first place. And I'd like to start with workers' safety, because we've seen some major suits in this area as well. And this brings, Alex into the conversation. Alex, you really, in just broad terms, what is an employer required to do to maintain a safe workplace?
Yeah, so everybody in the industry is actually covered under OSHA standards. The Occupational Safety and Health Act has a general duty clause that every employer must keep the workplace free from hazards that are known to cause serious injury or death. And it's a very broad statement, but what it means is that everybody's responsible for keeping a safe workplace, and they have to, at minimum, identify the major hazards and apply appropriate controls and try to mitigate those hazards. So very broadly, everybody's responsible, and even workers. I think that's one of those misunderstandings too, is that workers in this industry have rights. A lot of times they're not aware of them, but they also have responsibilities as well to keep a safe workplace as well.
Right. So there's the federal standard, the OSHA standards, right? But so what happens if an employer doesn't do what it's supposed to? What if it doesn't identify the risks? What if it doesn't identify hazards, or it actually underreports issues? What could
Yeah,
happen?
that's where this gets interesting. And OSHA, and I don't want to make it clear that OSHA, for the most part, everybody I've worked with, they're very helpful, and as an organization, they do have a lot of resources to come in and help. So this isn't an organization I think the industry should be scared of. I think they should embrace OSHA, and you should be aware too that there's OSHA states and then there's states that have OSHA state plans, which means the states have chosen to enforce OSHA standards through the state level agencies, and for the most part, if they're doing that, they have more stringent rules than OSHA. OSHA sets the base standards. But to the point, if they're not doing the what is required of keeping a safe workplace, identifying and controlling these hazards, it can be very serious. These violations, and it goes up every year with inflation. Think of it around 13,500 is where they start at, and they go upwards of, it's called willful, multiple or willful violations, a tenfold that, so 135,000, and that will go up at the beginning of the year as well. And so, if you fail to identify, it can be serious, and it can be within that range of violations. But if it's willful, that's when it's serious, right? If you've seen something in your facility that could hurt somebody and you did nothing about it, that's when that willful violation will come in. And I don't know many cannabis businesses that can handle a $135,000 violation. Very few can. So this is something. I mean, and I always come from the point of view, let's do what's right. Let's keep your employees safe. But that is a serious, financial stick there that owners should be aware of. So if they're not doing what's right to keep their workers safe, they should know that their business likely won't succeed if they face one of those fines.
Yeah. Well, it makes sense. But the risk is in terms of, how is it different in the cannabis space? I know it'll depend on the type of business, but, what's unique and different about cannabis that it's going to create, new types of risks or worker injuries? We have perpetual grow season with technology, trimming. What is it that's going to cause the concern, and what folks should be looking out for?
Yeah, and you're hitting on that with the perpetual harvest. I mean, ergonomics is really at the top of my concerns. There are a lot of hazards. There are hazards that cross into basic, other general industries, other agricultural industries. Pesticide exposure. And there's, in extraction, you have, you're using solvents that are potentially explosive. So there's a lot of unique controls there, but you can find best practices out there through different, organizations. But in this industry, it comes down to, I think the ergonomics is really, it's a huge issue that has not been fully addressed yet. We've done a lot of stuff through the NCRMA. We did a study with Penn State identifying hazards for trimmers there, and we helped build a safe workplace station table, and identified best practices to control these issues. But there still needs a lot of work done, because what's happened is that through the natural season, where we've just gotten out of what they call croptober, right, where the natural harvest happens. You cut down typically in October. You cut down all your plants, and usually it's about a harvest season. It's somewhere 4 to 6 weeks, roughly. I mean, I guess sometimes it can go upwards of 2 months, depending on how big and where the farm is. So for the longest time, this was a seasonal job. People would come in, they would harvest, and then they trim. And the trimming is a very unique process that really doesn't. It's not. There isn't something comparable in another industry. I guess maybe doing hair, cutting hair. There's similar, muscle groups that that people use when they're cutting hair, but there's really nothing comparable. And anybody that has trimmed or harvested knows the toll that it takes. And there's a lot of ignorance in this industry about their worker rights, and so they don't know that they have the right to, to ask their employer to help, with these issues, or to even report these issues. And what these businesses should have is an ergonomic process or program where they encourage early reporting, because they're not doing it just for 6 weeks, 2 months now. They're doing it 40 hours a week, all year round, and this is something that just bodies are just not meant to do. And so there's a lot of things that you can do to design the workplace to fit the worker better. There's stretching, there's job rotation, and there's things like that that they can do to mitigate these hazards. But understanding these repetitive motions and how to mitigate those, and again, how to encourage your employees to report at early signs where these symptoms, because they can turn into lifelong disabilities. And personally, I think this is something that it will turn into a major class action lawsuit in the future for many businesses.
Yeah, good advice to try to avoid that kind of lawsuit. So given the unique risks, though, so what's the market like for insurance? Right now, what's the market for coverage? What happens in practice?
So there's a lot of different, obviously types of coverage out there. And this is something too that, a lot of these business owners, they come in, again, it's a lot of ignorance. These are people who come in, passion project. They typically don't have a business background. And then they get to a point either on the application where they have to get, general liability, or they actually realize they have to get insurance. And so they don't know what's really out there. And these people tend to be very risk tolerant people. The people who have operated in the legacy market were obviously very risk tolerant. And so these are people who take huge leaps of faith, typically don't have the huge safety net underneath them. And so when they get into looking at policies, they don't know what to look for. And some of the major, there are a lot of subprime offerings out there, and I'm trying to be nice and diplomatic here, but there's a lot of stuff out there that I would not suggest. But these people will take them, and what I tell people to do is look at the exclusions. And property, one of the biggest gaps I see is that they'll exclude cannabis inventory, right, which is pretty important for cannabis operators. So really, this is one of those things that operators just need to learn what these coverages are, what's important to them, what happens, why are they transferring those risks? They need to transfer this risk because this is something that their business can sustain if that threat actually happened. And so they need to really understand, and that's the one I point to all the time. Look at the exclusions. Does it cover all the assets that you need to operate, and including your own, cannabis inventory?
Yeah, Joe, I just wanted to jump in on that. From the brokerage side for us and working with our clients, we go through that with them, and we kind of set up a plan to make sure we're covering what is absolutely necessary. As Alex alluded to, you need insurance to have a license in this industry, so there's some cut and dry requirements you can't get around, but it's important to understand where areas might be able to be pushed off for the time being due to the cash position of the company. And then other things you have to keep in mind is what your financiers want. So people like Anthony also dictate insurance requirements from time to time. So to Alex's point, it is important to understand what is and is not covered in each of your policies. So working with someone who knows what their, the policies are actually doing is extremely important.
Yeah, no, thanks for that, Isaac. So is there anything else you wanted to mention, Alex, in terms of the different types of coverage, theft, general liability, product liability? These are all matters that, a lender would be concerned about in terms of collateral and performance. Anything specific?
I would like to point out, one thing that concerns me in this industry, really, it's capacity right now. the industry is going into the East Coast, and there is going to be a significant amount of new businesses, operations, and the industry as a whole is just being underserved. There really, I don't believe, is enough capacity already in the industry. And I believe with the new businesses coming in, that's one of those things that concerns me. And there's of course a lot of different options to handle this, but some businesses I don't think will actually make it through without the right type of insurance. Self-insurance, captive options I think will be out there. But really ultimately it comes down to risk management. And I think that's one of the things that the industry really needs to realize is that managing risk, it's hard for the industry because again they're very risk tolerant in general, and it's hard for them to understand loss prevention. Well, I don't need it now. I'll just do the best that I can and hope that everything works out. But risk management is what is going to sustain these businesses in the time of a capacity crunch. If there's not enough insurance out there, I personally think some of these big multi-state operators will start self-insuring because they're going to be able to beat the market on the pricing. And so it's just one of those things that I think that many people aren't aware of, but when it happens, I think it's going to impact the industry as a whole.
Yeah, and it really leads to what you said really matters for the capital providers, and so we really want to hear from Anthony. Like, what do you like to see in terms of property casualty insurance?
We like to see that they have it. Let's start there. Alex's point is right, is spot on. There's not a lot of capacity for this. It's critically important. There is limited availability of this, but it is available. And so we've had some folks say, oh, I don't know if I can get it. It's expensive. It's just a part of doing business in this industry. And just the way Alex was saying that you need to transfer that risk to somebody else. Regular way business transfers that risk, and albeit at a cheaper price, but it's just the cost of admission, unfortunately, to this industry. Those aren't the type of risks that we can take. And so that's why we require folks to have that property insurance. Business interruption insurance is another one that we talk about. And we help, given we own 31 properties across 12 states, been in the business now for almost 4 years. We've developed a bit of a relationship out there with various folks. And so to the extent somebody has some difficulty, we certainly can help nudge them in the right direction. But I find that the larger companies have an easier time of it, because to Alex's point, those that are providing the policies are going to concentrate as much as they can their positions into the better capitalized or larger cap companies.
Makes sense. And let's just talk a little about litigation, because Alex, you mentioned it. It's certainly another source of risk for the operator, but it's also a source of risk for officers and directors, any major decision makers and those with fiduciary duty in particular. And a capital provider wants to see the operator avoid litigation exposure. One, because of the depletion of assets that could happen in the litigation, but also for the distraction to management as well. If the directors and officers are also sued, that's not good for the company and its operations. And even further, capital provider is not going to want to be pulled into the litigation itself, based on misrepresentations by its borrower. And investor class actions are a prime example where the investors, they claim misrepresentations against the company and its directors, and then the plaintiffs can try to rely in part on misreps by the borrower that they allege the lender should have actually discovered. And that's what's happening right now in a securities class action against IPR. It's yet to be certified, though. So Isaac, this is for you. Turning to insurance coverage related to directors and officers, can you just help us out with the basics? I think a lot of people hear about side A, side B, side C. It sounds very confusing, but who's entitled to D&O coverage, and broadly, what are the types of coverage that's available?
Yeah, I would say D&O is one of the more unique kind of insurance offerings because it actually is very different for a public operator versus a private operator. The way insurance carriers view it is they actually have two separate policy forms for a public company versus a private company. And one of the reasons is those large scale securities lawsuits that you mentioned, Joe. So from a high level, anyone who has outside funding, whether that's in the private sector or via IPO and then, public equities, should have some level of D&O insurance. So anyone who is operating in the space, anyone who's investing in the space, should be looking to have their companies and those that they invest in with D&O. The coverage typically extends to any current, former, or future director or officer of the company. So that can go from, an independent board member all the way down to kind of a mid-level manager who's making, larger scale financial decisions. So coverage terms by and large for who is insured is rather broad. Where coverage kicks in, kind of to your point about side A, B, and C, is where it gets a little bit confusing. All of those things are on the same policy. They're all coverage sections within the same policy, but they do slightly different things. So side A coverage is the only one that's not subject to a retention, which is the same thing as your health insurance deductible. It would be the cost out of pocket for the company in the event of a lawsuit. But side A does not have that provision in there because it is intended to provide coverage for the individual directors or officers of the company in the case that the company itself goes insolvent. So let's say, Anthony and New Lake are sitting on the board of one of their companies, the company goes bankrupt, but Anthony is named in a lawsuit. A D&O policy would provide side A coverage directly to Anthony, subject to no retention. And the reason being is the company itself cannot reimburse Anthony for any defense costs, so there's no retention for the individual. Side B actually provides the same exact coverage. It's just in the case where the company does not go insolvent. So this would be if a director or officer is named specifically in kind of a bad faith dealing, not necessarily something that's from bankruptcy or an insolvency situation. So side B, same type of coverage for side A, in that it protects the individual. However, it is subject to a retention because in the event of a payout, though it works as the insurance carrier will pay out the company excess of the retention, and then the company will then pay out the individual. And then side C is kind of what we call entity level coverage. So that protects the assets on the company's balance sheet. So if the entity itself was brought into a lawsuit and it depleted the company's assets, the insurance would then kick in at that point.
Well, that made it a lot simpler, I think, for a lot of folks listening. So appreciate that. So what types of coverage are you actually seeing in the market now? Like, what are the preferences? Does it vary by the type of entity, where they are in the process, cultivator, distributor, or retail?
Yeah, I think preferences kind of, differing again from other lines of insurance coverage. It's not so much preferences based off of what type of operation you are, because D&O is going to be the same for a cultivator as it is for a retailer. It's mostly going to be dependent on a few factors. One, are you, capitalized from outside sources? If you're, a mom and pop shop and you have, some friends and family funding, you're likely not going to purchase D&O unless you have some pretty poor relationships with your friends and family and they're going to sue you. So as long as you have outside funding, we're typically seeing companies at least interested in it. Obviously, there are certain requirements, for companies who list on the NASDAQ. On the high end, it's a requirement to have D&O insurance on the NASDAQ to even list. So we see companies purchase it at that point. Investors a lot of times require D&O insurance specifically for that side A coverage piece because they don't want to put someone on their board who's then personally liable for, something that happens within the company. So, in terms of limits, a lot of companies buy kind of a basic $1 million limit just due to premiums. What we have seen over the last kind of 6 to 8 months or so is premiums in the D&O space come down a bit. Insurance in general, not just for cannabis companies, has kind of entered a soft market, meaning carriers are fighting over insurance premiums. So we have seen some relative premium relief. Granted, the premium relief for the cannabis space isn't nearly what it is in other industries. But we have seen, preferences in terms of limits increase as prices have come down, because you can get higher limits at relatively similar prices. But the overall preference of the market is going to be a lot of times dictated by the decision makers within the company, not necessarily what your actual business purpose is. The only one that's really a requirement is if you're on the financial side, you'll want to have some sort of D&O E&O policy, because that protects your financial professional liability as well, because there is a kind of interesting gray line there. So that's really the only one that's kind of a cut and dry. They always prefer to have a D&O policy in place.
Okay. So the market's changing a bit. You said premiums are coming down. Is there anything in particular you can caution operators, people to watch out for in terms of key exclusions?
Yeah, so a lot of early carriers have regulatory exclusions on there. Obviously, that's a huge risk given it's not federally legal. We have seen certain carriers offer a certain level of regulatory coverage. Granted, if the federal government came in and had a sweeping statement that all cannabis was illegal and they were going to shut everyone down, I'd be interested to see what would happen in that case. But by and large, there is some level of regulatory insurance, and if you don't have that, you should probably be talking to your broker about finding a new carrier, because most are offering some level. Might come at a slightly increased premium, but not a huge deal. The other kind of key thing to keep in mind, and Anthony brought this up, is if you're publicly traded and you are technically domiciled in Canada, you want to make sure that the policy is set up properly. You want to make sure that you have the Canadian address listed, not the US operating address, strictly because, for a lot of these companies, the suit will likely be brought against that Canadian company. So if the D&O is not set up properly, there could be some coverage claims issues. So it really kind of depends on those sorts of things. And the private sector, by and large, there's no major kind of key exclusions other than the regulatory one. A lot of it is just understanding that when there's a professional liability exclusion on the D&O policy, that's basically saying this needs to be covered under a professional liability policy. It's not saying D&O policies aren't intended to provide that by and large. So it's just about education in general, but that's kind of where the industry has gotten to, that at least from a coverage form perspective, it has gotten closer to other industries.
Yeah, I think that's really helpful advice for folks. Is there anything else you wanted to mention in terms of, availability of coverage and where you see the market headed?
Yeah, I think we have seen some new entrants into the space. By and large, like I mentioned, premiums and coverages are getting a little bit more palatable. Retentions are still staying pretty high, meaning that, like, for public companies, you're typically starting at $1 million retention, which if you buy $1 million of insurance, $4 million with $1 million retention, sometimes hard to get your head around. So we have seen companies kind of move towards some different unique solutions, kind of like Alex had mentioned, and looking into more of a captive situation. Problem with that is the capital situation for a lot of cannabis companies right now. They can't necessarily finance a captive at the current state. So as the industry matures, to Alex's point, that's going to become a huge kind of market mover for the insurance industry as it relates to cannabis.
I see. And I want to ask Anthony now, actually, like, how important is D&O coverage to you as a capital provider, Anthony? What do you look for?
It's important to see if they have it. It's not a requirement, though. We've touched on here the cost benefit analysis. I mean, we go through that analysis ourselves, and so we get it. It's really there for the directors. But more importantly, what we look for is, what are the operators saying to their investors, right? How are they positioning their business? What's the type of disclosure that they're taking in their capital raising documentation? What are they showing in terms of projections? These are the elements that create risk for the organization. So whether they have a policy, or they don't have a policy. Even if they do have a policy, there'll be a large deductible. So those first risk dollars are coming out of already a scarce capital base. And so for us, it's more about understanding how are they positioning themselves and are they creating undue risk around this particular topic? Because that could tell you a lot whether they have insurance or not.
Yeah. Yeah, it's a measured and a savvy way of looking at it. I think we should just move on. Just some final thoughts. We're a little close on time now, so I just want to ask each of you the same thing, which is your point of view on what's going to be a major issue. I know there are going to be several, but a major issue that comes to your mind for businesses going forward in the space. And I'll just start with you, Alex.
It's really hard to predict when anything or if anything is going to happen in this industry, especially at a federal level. What is smart is to prepare. And so I really feel it is really important for businesses to really enhance their best practices, their standards, and really, it really comes down to risk management. I think risk management is something that is not fully known, or the as a whole, this industry really doesn't understand it, doesn't know the value. But I think for businesses, if they want to compete long term, they're going to really have to keep costs lower. They're going to have to keep financial costs lower, and they're going to have to keep the human costs lower. That it comes down with worker safety and product safety. And what really worries me in this industry, really, I'll tell you, it's the product safety issue. I really see some of these contaminations, some of these mold issues, mycotoxins. We're really at the early stages of this industry, and I don't believe most of the businesses are prepared. And I don't know when the next shoe is going to drop, but if I had to put money on it, I really think product safety, both in the hemp space, which I think is actually much higher risk product safety wise, but also in the marijuana or cannabis space. I feel that, some of these product liability claims could start picking up. And if these businesses don't do what's necessary to control those issues, it could be bad news for many of them out there.
Got it. Be prepared. Product liability. More issues coming. Isaac, what do you think? What's on your mind for the industry going forward?
Yeah, absolutely. I think, as we could see continued consolidation within the space, one of the key areas is just making sure that, Alex's point, your risk management, and then for us, your insurance kind of aligns and you're capturing all the various risks of this new, venture you might be, entering into, whether you're the acquiring party and you need to roll company's insurance in, or if you're the acquired party and you need to wind down your company or pass off that risk, there's considerations to be kept in mind on both ends. So it's really important to understand, where those exposures are and how to address them, and if it makes sense to, utilize insurance as a way to, cover those, because we have seen some larger scale M&A deals have some issues on the insurance side where things that they thought were covered were not, and that caused a whole nother layer of complexity of the deal and, slowed things up. And as everyone knows, no one likes to wait on the insurance people to get things done. So it's important to kind of get it taken care of on the forefront, and make sure that you're well prepared in advance for any of those things that might come down the pipeline.
It's, smart use of insurance, and really that's a measure of education for everybody, which we're trying to do here today. And Anthony, what's on your mind?
I put it in the category of hope for the best, prepare for the worst. We touched on it in our earlier conversation about should people wait for safe banking. And again, I said there, maybe because it's weeks away from knowing if it'll happen or not. But what I notice in this industry is it's populated by entrepreneurs that have such hope for the industry, such hope for their business. And that energy is so necessary to overcome all of the obstacles. But don't bet the farm on that hope. I'd say, again, hope for the best, prepare for the worst. Don't think I am going to believe that my cost of capital will drop significantly over the next 6 months. Don't believe I will grab 10% market share in the first year of entering a new market. Be very realistic. Recognize that it's better to be in business and maybe have maybe not have the cheapest capital structure that you ever thought was possible, but maybe it's better to do that than actually hold out or take on extremely expensive capital today with the belief that your cost of capital is going down, or holding out and saying, I'm not going to raise capital because the market's coming my way. I would just encourage people to hope for the best, but plan for the worst.
Yeah, that's great. So realistic optimism, right?
Yes, has to be rooted in reality, and often we see that in the presentations that we see. We can see when it's unrealistic hope.
Yeah, sometimes I'll tell entrepreneurs, like, there's passion, but it's better to have fact-based passion.
Yes,
that's the way to go. So I know we're short on time, but we do have a few questions that have accumulated here. So I just want to run through a couple if stick around a little bit longer. So Alex, this first one's for you, because you talked about the health risks. There's been talk about occupational asthma getting some play. So, how big of an issue is this expected to be, and how are carriers going to deal with it?
There was a tragic death in the industry, and it's getting quite a bit of press right now. I mean, and as it should. I think, the media sometimes goes for more sensational headlines than, diving deep into what's happening. But so occupational asthma is a real thing, and most people aren't aware. You can actually have a sensitivity or a full-blown allergy to cannabis. I have a few friends, worked with a few people who are actually allergic. I know this blows people's minds because there technically hasn't been a death of an overdose of cannabis. It is an extremely safe plant, and so when people hear this, there's a lot of skepticism. Oh, that's not real, but this is something real. People will break out in hives, and they'll get itchy red skin, but then it leads to some type of potential asthma and breathing issues. I mean, there's been reports of anaphylaxis, and I believe that's what actually happened in this tragic worker's death. And she was working in a pre-roll area, and it's this dust that comes up, and I'm not sure if there was a previous symptom. There are reports that there was. And if that's the case, this was a tragedy that potentially could have been avoided. But what businesses need, they need to train their employees on what these symptoms are, the itchy skin, sensitivity, breathing issues. And then what they need to do is they need to give the employee proper personal protective equipment. So if they're breaking out hives, can they remove that issue by putting on proper gloves, potential N95 masks in these dusty areas. But some of these people need to be kept away from the plant, and I know that's something that's difficult if you're producing cannabis, but this is something that they need to be aware of. And they also need to encourage early reporting. So as soon as the employee, just like with ergonomic issues, as soon as they see or feel a symptom, they need to report this, and they need to go to their managers and tell them what's happening. Early reporting is the best thing that can happen to prevent these issues. I don't believe it's something that's going to affect a great amount of people, but the people that it does affect, it can be severe, and we just learned that the hard way. And so businesses, they just need to be aware. I mean, this is just a hazard. People need to be aware of. There's proper controls out there. It doesn't need to get to what happened earlier this year with the death, but the good news is it's controllable, and they just need to be aware of it.
Okay, yeah, and it seems like it's a very hard claim to prove, given all the confluence of factors that can go into the reaction. But so we'll see how this shakes out. Isaac, there's a question for you. If full coverage isn't available or too expensive, are there alternatives? Are operators just taking only Side A coverage that you had mentioned?
Yeah, we have seen some companies take on side A only, whether that's on the primary basis or as an additional excess layer. A lot of larger operators will buy a full ABC underlying policy for, let's say, 1 or 2 million, and then purchase an additional excess limit of 1 to 5 million with side A to satisfy their board members. So it's definitely something we can work around, and there's even side A and B coverage that just excludes side C. Not typically as big of a premium savings as going side A only, but it is definitely something that we've worked with a lot of our clients, both on the public and private side, to look to provide coverage for that on the side A only basis.
Okay. Okay, and as final question, I promise this is for Anthony. How can an operator make themselves attractive to a capital provider? How do you lower the perceived risk? What kind of operator represents the total package to you?
There's nothing one can do to polish up the organization, if you will. What we look at in underwriting a property or in underwriting a transaction is 3 primary factors. One is the property itself, nothing you can do about that, or I guess it is where you're locating your business, whether it be cultivation or a dispensary. 2 is the financials and management team, put those together. So you are who you are, have a solid background, preferably a background of some previous success, so we can have some reliability on your management team's ability to execute the business plan that's put in front of us. And also some financial experience, meaning experience generating revenue. We don't in particular do startups, but experience generating revenue in the industry, hopefully generating some profit. Hopefully, if you're not generating free cash flow, you have a plan on a very reasonable plan on how to get yourself to generating free cash flow from operations. So it's about running a good quality business. It's what you're going to want to do for your investors. And then lastly, we look at the jurisdiction. We very much like to focus on what is the jurisdiction where the property is located in. Is it a limited license jurisdiction? Is it a wide open jurisdiction? What do the competitive factors look like? And that really tells us a lot about what we think the staying power of the business will be over time. So there's nothing anybody could do per se, say, before I make that phone call, let me do this, that, or the other. It's really about executing your business well and generating the returns you want to generate for your investors.
Yeah, that's great, Anthony. Doing the right things and also being in the right place.
Yeah. Location.
That's all the time we have for today. I want to thank the panel for a great discussion. Thank you all for joining us today, and also thanks to Alpha Root and BKS Partners for making this all happen. Thank you very much.
Right back at you. Thank you all.
Thank you, guys.
You, Joe. Thank you. Bye-bye.